Welcome to the debate. We're diving into one of the most immediate and I think complex challenges high earners face, the phenomenon known as lifestyle inflation. It's that moment when a substantial rise in income almost automatically leads to a commensurate increase in spending.
And for people pulling in six or even seven figures, this is not some marginal issue. We're talking about fundamental, often really high cost shifts in their standard of living. Buying the bigger house, the faster car, paying for private school tuition. So the core tension we really need to get into is whether this natural spending increase is a rational deployment of capital designed to maximize performance and future earning potential, or if it is an insidious mechanism that just silently erodes long-term financial security and optionality.
Exactly. And I'll be arguing that for the truly affluent and ambitious, this kind of intentional spending is a smart, rational investment. It's dictated by sound economic logic, and it's aimed at maximizing total lifetime wealth creation. Upgrading your inputs is frankly essential to upgrading your output.
And I'm going to present the opposing case, that this consumption often functions as a hidden wealth tax, one that leads directly to financial fragility, reduced optionality, and the stress of the so-called golden handcuffs. It actively, and I mean actively, constrains future freedom. Look, my position is really rooted in a critical observation. Equating high income with financial security is perhaps the most dangerous financial myth for higher earners. The two are they're totally distinct metrics. Income is flow, wealth is stock. And we see profound evidence of this disconnect in professional groups known for high earnings, especially those with delayed career starts. I mean, think about physicians. Their average annual income is somewhere around $350,000. Yet despite this phenomenal earning power, the data shows that a significant minority, nearly 28% of those doctors, still report a total net worth under $500,000. That's a massive gap.
That is a stark number. But to be fair, that income usually correlates with substantial educational debt, which has to complicate the net worth figure, at least early on.
It does. Precisely. The debt is a factor, of course, but lifestyle inflation is the accelerant. It operates as a silent drain because high earners immediately channel that extra income into increased fixed costs. Bigger mortgages, high-end car leases, staffing, expensive tastes. This habit often masks these underlying issues, like, say, insufficient retirement savings, or even worse, new debt accumulation. The immediate, gratifying consumption, whether it's luxury items or high-end services, it just overwhelms the long-term goal of building true, liquid net worth. And so they end up financially fragile, needing that high income just to service the cost of living they've chosen for themselves.
Okay, I see why you frame it as a psychological trap. I do. But let me introduce a different perspective, one that's rooted in, rational economic behavior. Not all lifestyle increases are the result of wasteful, undisciplined creep. Many are intentional, high ROI upgrades, and they are in fact rational economic decisions for affluent households. They're aimed at optimizing both life and work output. We have empirical evidence suggesting that affluent households, in response to large income gains, say a major annual bonus, or a windfall equal to a year's income, they display a really distinct marginal propensity to consume, or MPC. This is the proportion of an extra dollar of income that gets spent rather than saved. And crucially, this MPC is often slightly higher for the wealthy than for the less wealthy, meaning they are more comfortable spending a larger proportion of a new windfall.
Why, but doesn't that just reinforce my point about fragility, that exact tendency to spend the windfall?
It only reinforces it if you assume they are spending on necessities. But they aren't. This increased spending is concentrated on non-necessity or luxury goods, things like high-end durable items or frequent dining out. This all relates to a concept called non-homothetic preferences, and these items are easier to anticipate or postpone than, say, essential purchases. But more critically, theoretical models show the inflation rate on these non-essential goods often grows faster than the prices of necessities. So anticipating and purchasing these items or establishing the infrastructure for this lifestyle now can actually be a rational choice. And beyond just hedging against inflation, this spending is a targeted investment in high ROI inputs. Scaling strategists sometimes call this Phase 1, buying back time. So by delegating low-cost administrative tasks, the $1 or $2 sign work, like scheduling, email management, travel planning, the high earner frees up crucial capacity. This enables them to focus exclusively on their core, high-value, high-profit generating activities, whether that's specialized legal counsel or coding or high-level strategic thinking. This expenditure literally accelerates their most valuable asset, their own billable hours.
I appreciate you bringing the non-homothetic model into this, and I do agree that strategic delegation can buy time, of course. However, I really have to question the term rationality when you factor in the crushing force of opportunity loss. This is where the compounding equation flips completely against the high earner. I mean, for many of the professionals we're discussing, particularly those with professional degrees, there is an inherent delay in their earning curve. They start investing 5, maybe 10 critical years later than someone in a different field. And every single year of postponed investment sacrifices irreplaceable compound growth opportunities. If they immediately inflate their lifestyle instead of maximizing early, consistent investment, they lose that crucial decade where capital growth is it's exponential. Their eventually higher income simply cannot fully overcome the massive difference in time and market. And when that lifestyle inflation involves lifestyle debt, a high mortgage, or chronic credit card debt, compounding works in reverse. And it just amplifies the initial mistake and creates a deep financial hole.
I see why you focus so heavily on that immediate compounding rate, but I think we have to frame this debate around maximizing total lifetime wealth creation, not just maximizing the savings rate in any given year. Strategic, high-end spending is often necessary for high-level networking and business scaling that can generate returns far, far beyond what typical investment compounding can achieve. We observe that the financially elite, they deliberately cultivate social capital networks. They attend exclusive, high-cost events, whether that's in Aspen or the Hamptons, and they deploy capital into these access points to generate what's been called relationship compound interest. And what that means is that a single high-cost engagement, like a weekend at a major conference or some exclusive dinner, can lead to a financial partnership, a major client, an introduction to a deal flow that generates millions in new revenue. The expense is mathematically trivial compared to the potential financial multiplier. So this spending is an investment in generating returns that are inherently increasing with wealth, and that is a rational deployment of capital.
That's a compelling argument. It is. But let's talk about noise versus signal here. Has anyone actually measured if attending those $10,000 dinners is more valuable than simply focusing on core performance? Strategic scaling requires doing less and focusing, not just buying access to more high-cost activity and complexity. We have data on scaling businesses that shows the power of the 80-20 rule. In some cases, 80% of an agency's profits came from focusing on just one core service. So if you are already maximizing the 80-20 rule in your professional life, then a lot of that luxury input spending, the high-end travel, the constant entertainment, the need for visible symbols of success, that might just be noise that distracts from your core competence. Unnecessary consumption spending is precisely what traps the high earner. It prevents them from ever scaling back, from reducing their work hours or escaping those golden handcuffs because their rising fixed costs necessitate the continuous high-stress job just to maintain their new normal. It eliminates their optionality.
You know, I'm just not convinced by that line of reasoning because it assumes the stress and the pace inherent in high-level achievement is purely detrimental. While the golden handcuff scenario is real, we can't ignore the observed correlation between income and life satisfaction. Higher income is, broadly speaking, associated with greater life satisfaction across all income values.
Correlation, yes, but let's dig into the stress component of that.
The general population, the probability of experiencing stress increases significantly with income around $63,000 household income. However, for respondents already reporting high life satisfaction, the group they identify as thriving, that stress turning point becomes significant much earlier, around 37,000. This implies that for some high performers, the accompanying stress is a functional, even desirable component of an ambitious, high-achieving lifestyle. They actually welcome the tension because it pushes them toward the necessary, rational expenditures, like buying back their time, needed to facilitate that high performance and maintain that thriving state.
That's a very interesting psychological point about the thriving cohort, but I think their early stress turning point might simply confirm the speed with which the trap closes. The high-cost lifestyle, the elevated consumption of durables and non-essentials, that is what fundamentally creates the mechanism of the golden handcuffs. It's not just financial, it's psychological. Once you set a new normal, the difficulty of reversing this, of downgrading a lifestyle, that is the silent tax on future freedom. I mean, think of the psychological cost of unwinding that elevated standard of living. It feels like failure, a step backward, which is something people deeply resist. High fixed costs make maintaining high-stress jobs not a choice but a necessity, and this drastically reduces optionality. The ability to quit, to transition to a lower-paying but more fulfilling role, or to take a risk on a startup. The high-earner consumption structure demands continuous engagement in that high-stress environment, and that often leads to burnout.
I'll concede that the perception of loss of control and the difficulty of downgrading is a real psychological hurdle. I will. But I insist that the structural high income is actually the factor that allows for the solution. The fundamental response needed to avoid burnout is internal. It's a mindset shift that high income makes possible. High earners who recognize this trap can achieve a sustainable working model by adopting an abundance mindset and setting firm, non-negotiable work boundaries. And this includes saying no to non-core projects that generate minor returns, rigorously applying the 80-20 rule to effort, and refusing to internalize conflict. This approach reduces burnout without sacrificing the high income that's necessary for strategic, rational consumption. The high income provides the dry powder and the security that allows for this liberating mindset shift, the confidence to reduce risk and say no to marginal work, while still funding the investments in time and network that truly matter. The high-end spending is the infrastructure of that sustained high performance.
Ultimately, while maximizing income is undoubtedly valuable, that economic impulse toward a high marginal propensity to consume on non-essentials dramatically raises the fixed cost of living. And this transforms high income into a structural constraint and a psychological vulnerability. The structural need to maintain those high fixed costs, often coupled with the irreversible loss of early compounding time, it just can't be fully compensated for by networking or efficiency gains alone. They've traded future flexibility for current consumption.
And I would reaffirm that for the affluent, intentional spending isn't inflation. It's a rational, anticipatory investment. It follows sound economic logic, recognizing the cost of time, and the exponential returns of social capital networks. This spending is a strategic deployment of capital that optimizes professional performance and maximizes the creation of wealth over the entire span of a career. It is dictated by the rational economic demands of high-level professional engagement.
The fundamental distinction, then, between a rational investment and a future trap seems to depend entirely on whether the specific expenditure increases your optionality and freedom, or whether it restricts them by raising your required fixed costs.
Exactly. And the core question remains a deeply personal one, and it's often unresolvable. Which cost would the listener personally rather pay? Less freedom and flexibility later, or less immediate optimization and enjoyment now?